Good evening and welcome to the live stream. On this live stream, we're going to talk about stocks and we're going to do fundamental analysis on stocks and see if we are looking at a company that is priced well, if it's priced at a discount, or if it's priced at a premium. We're also going to look at how that business is doing. Does it have momentum? Is the top line revenue growth growing? Does it look like the next few years for that business are going to be good years, or are they struggling and they're going to continue to struggle? Also, look at how the market's treating that particular industry or sector. Is it a sector that the market just loves and it's buying it up, or maybe it doesn't like it and it's selling it off for irrational reasons at times? We're going to take a look at that. If you're on the stream and would like to talk about a stock, put it in the chat. If you're a member, we will dissect that stock. We will take a look at it, analyze it. If you're not a member, no big deal. You buy a $5 super chat and we will analyze that stock. Feel free to ask questions as well. As we look at the market in today's action, it was a mixed market. The space that made it out the best was energy because oil is really expensive right now. We have high oil prices. So companies that are extracting and selling crude oil are doing really well, especially these smaller companies. And they are doing well for the year. They did well toward today. Even the majors had a good day. So energy stocks are doing well. Some other stocks are doing okay. Broadcom had a good day. So did AMD. The stocks that provide semiconductor materials also did well. Computer hardware had a good day. And some financials had a decent day. Looks like Citi made it out through the day quite nicely. We had some stocks struggle. Micron had really good earnings announced. Near perfect, if not perfect earnings. But some investors, I think, have happy feet. They would like to cash in the big gain they have on Micron. That's understandable. It's done really, really well. It's up more than 300% 1 year. So that's understandable. Maybe it'll rally tomorrow or next week. Meta hasn't really had a very good year. It's actually down for the year. And it struggled again today. Tesla struggled a lot today. Healthcare, looks like the healthcare payers had a bad day. So did materials. Gold and copper sold off quite a bit. Netflix sold off. So it's been a year where picking stocks has really been the difference between having a positive or a negative year. It's been a tough year. It's been a hard year to figure out. You have stocks like Micron up 55%, the semiconductor space just flying high. And at the same time, you have software stocks that have been under a lot of pressure. Energy, of course, is probably the most consistent sector for 2026, going up nicely. Industrials have fared okay, so have consumer staples. Materials, some materials have done well. Large pharma companies have done well. But some other areas have done very poorly. Financials, for the most part, is down. Amazon, Tesla down. Consumer discretionary under pressure. Meta down 8% for 2026. Nvidia down 4% for 2026. And Apple down as well. So it's been a year where we've seen some of these sectors that were doing so great for 3 years give up some of their gains, and some of that capital ends up elsewhere. I think that's a healthy market. If we do have a rotation and you see some of these sectors that were left behind, didn't pick up a lot of investors for 3 years, begin to see some investors come in and buy those stocks up. Looks like Anderson is on. I am doing well, Anderson. I hope you're doing great. Thanks for joining. So overall, the heat map is showing where the market's trading and what the market likes, especially today. The market did sell off today. It wasn't a positive day. It was a negative day. It was far worse. recovered some of the losses today. As you can see, we were down quite a bit, and the market did rally toward the end. So could have been worse. Today we had earnings come out. We had Alibaba before the market opened, and their earnings were mixed. You had some good news and some bad news, and the stock sold off. Accenture announced. I'd like to take a look at Accenture. FedEx announced. Like to look at FedEx. And what else looks interesting? Darton Restaurants. That doesn't really float my boat. I think that's it from the stocks that I'm seeing. There's some neat names there, but they're small caps, so I'm going to leave those off to the side. Now, I wanted to take a look at Accenture because they had a small rally because they do professional services. Accenture provides strategy and consulting. They do professional services in the Americas, Europe, Middle East, Africa, Asia Pacific. It offers systems integration. That means implementation of software or systems, application management, security, intelligent platform, infrastructure, software engineering, data, AI, and so forth. So these guys help businesses implement new pieces of technology. AI was noted as being a big revenue driver for them. And, we've heard the story that AI is potentially going to hurt software businesses. What I was curious to see about Accenture is if they're growing, that means they're probably implementing software and they're probably helping customers with AI as well. So let's take a look at their investor page. Let's see if that's on here. And then we'll dissect their financials. Looks like I'm going to just need to type it in here, and then we'll get to the investor page. Okay, so here's the second quarter that was announced today. So Accenture delivers record new bookings, revenues at the top of the company's guidance, strong profitability, robust free cash flow. So new bookings, they increased by 6%. Revenues increased by 8%. That's a pretty good number for a quarter. They are fairly big. They're a big company, so 8% growth is a victory for a big company like this. All right, so that looked good. So they're booking more. They're collecting a lot of revenue. It looks like they're consulting and then managed services. So the difference there is consulting is project-based. They're implementing something new. And then managed services is they're managing something that's already in place. This is a little more interesting to me than the other because it shows that, hey, there's activity out there. There's activity to implement new systems, maybe implement AI, agentic AI or whatever the company is putting in. All right, let's see what else is interesting in here. So cash flow, is this cash flow per share, excuse me. It looks like it did go up quite a bit. All right, so I like seeing the revenues grow. Looks like for the fiscal third quarter, they're guiding and the growth will be 1% to 5%, which isn't all that exciting, but maybe they're just setting a low bar and they plan to beat it. All right, so that's what their earnings are about. I come back to, I think it's good news for software stocks that Accenture is doing well because the fact that Accenture is growing shows that businesses continue to implement technology, software, uh, new programs, and so forth. So that's a good thing for the likes of Salesforce, ServiceNow, and everybody in the application software space. So let me show you my evaluation of Accenture and share with you what I think of the company. Now, a couple of things that I'll point out on their fundamentals. Before I jump into that, looks like Anxious Hamster is on. Good to see you. I'm not quite sure I'm placing your comment in the right place in my mind. So 67% up based on last accumulation. And was that on Micron or not sure? Good to see you. Okay, so a couple of things. Accenture is in the technology space, but they're in the services space, and it's very different than operating a software company or semiconductor company. The big difference is on the margins. Gross margins of 32%, and the net profit is 10.8. These are very respectable numbers, but they'll never be like Nvidia in the mid 70s or let's say Salesforce, which is way up in the 80s. So those are the things that are going on there. One second, guys. All right, sorry guys, that was my wife. All right, so the numbers are okay, but they'll never be, really great numbers in technology. So that's why I'm not overly in love with services companies. I'd rather own technology companies that have a product, or they might provide software as a service, and they have much better margins. The revenue for this company is very high, 72 billion. So you're paying less than 2 times sales for the company. If you look at like a product based company, you're paying 10 times sales. Just has a much better price to sales ratio. All right. So Anxious Hamster, Woodside. Cool. So you want to take a look at Woodside? I'll take a look. Let me make a note of that. And let me finish off on Accenture. Okay, so we've got 22 analysts. They think it's discounted nicely. This stock is beaten down, and they're supposed to continue to grow that single digit. And again, that bodes well for the software space, for companies that need Accenture to implement new software programs, because it shows that the economy is doing quite well. There's no AI disruption in the space. The revenues are going to grow nicely. So this is a good stock. This is a good looking company. It's just not my favorite category. I'd rather own software companies. And these guys here, over the 1 year, it's down quite a bit, 37%. Pays a nice dividend. And it hasn't really done all that great over the 5 year. So not a bad idea. I think these guys are going to continue to perform well. And might be a pretty decent pickup for an investor that understands that, hey, this isn't going to fly up like an Nvidia, or in the heyday of software companies, they would really fly up. But who knows? Maybe if we finally get this story that AI is going to kill software companies kind of put to rest, Accenture might pick up a really nice rally. All right, so let me take a look at the valuation I have for Accenture, and I think I need to update it. So let me take a peek at the valuation. And here it is. Looks like I am a quarter behind because they just announced their earnings. So let's update that and we'll see where we land. Looks like Kurt is on. Ask Atari Kid, thanks, man. You want to look at HAFN? You got it. Appreciate the super chat. And I like your handle, man. I'm a fan of Atari. And here we go. Okay, so we're going to update this on the 19th. That is today. I'm going to open up a screen showing me the fundamental data that we were just covering, and I'm going to update my valuation sheet. All right, so the free cash flows have improved nicely for Accenture. They've been increasing their cash flow, so nicely done. They're up to $12,497,000,000. Grow by 7%. That's logical. You saw that the revenue growth was going to be single digit. So I'm comfortable with that 7% growth. Let's take a look at the cash balance and then the debt level. See what kind of cash and debt these guys are carrying. And it looks like the cash balance, $9,410,000,000. And then they're carrying $8,350,000,000 of debt. So a nice discount on cash. That's looking pretty darn good. I'm beginning to like this services company. I have to admit, I really like cash flow. And it's almost, I've said this before, which is companies that we invest in, they're in this investor's mind, they exist to generate profit and cash flow. Of course, they do other things. Like I own United Therapeutics, and they provide drugs that help people that have these rare diseases. If they didn't have the drug that United Therapeutics had, they'd probably die. So it's great that they're doing that. But at the end of the day, I measure the scorecard is how much cash, how much profit, do they have a sound balance sheet? What's their growth look like? And so far, Accenture's looking pretty good. It was a down day and they rallied higher for good reason. Their fundamentals are looking pretty darn strong. So nicely done, Accenture. You're swaying this investor from being a non-services investor to maybe I got to think about that. So it looks like we're going to finish this year, August 31st. And we're right in the middle of this year. They have earnings per share of $13.98. I'm going to go with the $15.08, which is the next full year. I'm not going to give them a 25. I'm going to give them a 20 PE ratio with a growth rate of 7. That might be a little optimistic. So Accenture is nicely discounted. The other thing I like is that dividend. I don't invest in stocks for the dividend, but if it has a dividend, it's a plus. They have a dividend that pays 3%, north of 3%. So this stock is a buy in my book. It's looking good. It's been beaten down, but they're making money. They're growing. So I'm going to have to think about Accenture. Think about maybe picking up some shares. I have plenty of technology stocks, but I do not have a professional services stock. So I'm going to sleep on it, maybe buy some Accenture tomorrow or next week. We'll see. I'll give it some thought, but the numbers look really good. That's why I look at the numbers. That's why I look at the earnings. It's so that in some cases I turn around on a stock. Give you a recent success story on live streams. Other investors wanted to look at Sprouts Farmers Market. And probably 2 years ago, Sprouts Farmers Market was the number one performing from a stock price appreciation perspective grocer. Just killing it because they were growing really well. Let me see if I can show that. Look at that beautiful chart. And then they didn't grow as well. The market did not like it, and it sold off. And investors just pretty much were taken out behind the woodshed. Well, it was requested. We looked at it. I looked at the fundamentals, and I'm like, this is a pretty good idea. It's still growing. You see this growth here. The profits there, decent balance sheet. PE ratio is really low. Long and the short of it is, I bought the stock about a month ago, and it's up 25%. So that's why I analyze companies. And it's great to be on live streams, and you pretty much take me to, let's call it, more random stocks that I wouldn't think on my own. I'm just one investor. But together we just have these ideas of, hey, this might be a good idea. Hey, that might be a good idea. And whoever brought up Sprouts Farmers Market, I will thank you for the idea. It's been a good stock. And I can go through, there's probably 10 stocks that I could show as examples like that. Maybe Accenture is going to be the next one that takes off soon. I've seen a nice rally in software stocks. We will see. All right, so let me jump into, we're going to look at Woodside and we're going to look at HAFN. Let me check the chat, see how everybody's doing. It all started with Atari. So real quick, I just saw another documentary on Atari, right? I had a vintage arcade. I had a cabin up in the mountains, and it had 600 square foot arcade with 8 to 10 arcade machines, pinballs, and everything. I had asteroids. I had a bunch of games, and I was a fan. And I totally know about Atari. And Atari is where Steve Jobs, he went to work there. So did Wozniak. That's where they met. And they left and they started Apple, which is an interesting little fact. All right, let's get into Woodside. So Woodside Energy Group, I think, is the one you want to look at. Correct me if I'm wrong there, anxious hamster. I think you want to look at. Yep. I agree, sir. All right, so let's get back to work here. Let's get back to work on Woodside Energy Group. What are these guys doing? Are they cranking it up? Oh, yeah, baby. Oh, yeah, 57%. That's what I'm talking about. Man, this is a good stock. $46 billion market cap. Woodside Energy Group engages in the exploration, evaluation, development, production, marketing, and sale of hydrocarbons in Asia Pacific, Africa, the Americas, and Europe. It produces liquefied natural gas, pipeline gas, crude oil, and condensate, natural gas liquids. Of course, oil prices are going through the roof, and there's also a shortage of natural gas. Both prices are going up. So these guys are a smaller energy company. And when oil prices go up, the smaller companies just fly high. What's good about integrated big oil companies like Exxon is they can weather downturns a little better. They also pay big dividends. Look at these guys. You're up 68% over the 1 year, and they paid you a 4.4% dividend at this high price. If you bought it down here, you're earning 8-9% dividend. Hope that's the case for you, sir. Hopefully you're making all kinds of money on that anxious hamster. So what's going on with Woodside? They're flourishing with the high oil price. Now this is probably going to turn nice and green because high oil prices came in really at the beginning of 2026 and really began to just take off over the last, call it 30 days. So we've had oil prices now in the high 90s. And at that level, these companies are really raking in a lot of profit and a lot of cash. So this is going to turn green and their revenue is going to go higher. Their profit's going to go higher and their free cash flow is going to go higher. All those things are good. Margins are very good. They're small. Look at these profit margins. It's already at 36%. And basically, crude oil in 30 days has gone up more than 60%. Top line price. So that means that Woodside adds 60% to their profits. So their profits are going to go up another, add 20% to that. So their profitability is going to be 50, 60%. It's just going to be really, really ridiculous when they announce. They announced their earnings in February, so they're going to announce in May, and they'll announce third week of May or so. And it'll probably be a real ridiculous earnings. Like, oh man, we made gobs of money. We're going to have a one-time dividend, and we got a big, strong balance sheet. Speaking of which, let's take a look at this balance sheet. Make sure we don't have any skeletons in the closet. $6 billion in cash, debt of 13.7, debt to EBITDA ratio of 1.7. We are good. We are good with the balance sheet. If it's less than 3, then it's a good balance sheet. If it's 0, it's an excellent balance sheet. So this one's doing just fine. So I expect higher dividends out of these guys. Where's oil going to go? Well, at this point, it doesn't seem like there's a solution to the Iran-U.S. conflict. We'll see. We'll see if we're going to be in this thing for 2 weeks, 2 months. If we're in this for another month and a half, the year is going to be tough for stocks, and the year is going to be tough for the economy because oil, gasoline prices, diesel prices, they eat away the discretionary spend from the consumer. It puts a lot of pressure on businesses. The one sector that flourishes, energy. Woodside's going to make money hand over fist. And the rest of the market's going to struggle. Even technology is going to struggle. So this one's just been a good one. Congratulations. I'm glad you own it. I've been buying energy stocks. My strategy was as soon as I knew oil was going up, I decided I'm just going to buy on any down day. I already owned, coming into 2026, I owned Chevron and Oxy, and I've added 2 stocks to the list of energy stocks that I wanted to buy into. On any day that these stocks trade down, I just buy them. I buy, the new ones are Canadian Natural Resources, doing really well. SLB had a good day today. It was up 5.5%. So these are the 4 horsemen here. Any down action, I'd buy it. And I treat it as kind of an insurance policy. If oil prices continue to go higher, I'm making money on those energy stocks. If oil prices come down, it's going to allow the rest of the market time or room to recover. Well, a lot of my other holdings are going to bounce up. So that's good. It's kind of like heads I win, tails I win. It's my little insurance policy. So I'm buying this as quickly as I can on any down day. And I'll adjust as I see if oil starts to go down and it gets below 70, I'll probably pause that type of strategy. But right now it's working. So I've been doing that. I'm glad it's also working for you, anxious hamster. And hopefully it keeps working. All right, let's talk about HAFN. HAFN. So this is Hafnia. This is a shipping company. Hafnia Limited owns and operates oil product tankers. Oh man, these guys are probably going to be making boatloads of money. And that is a pun that I meant. It operates through long range 2, long range 1, medium range, handy size specialized segments. The company transports clean and dirty refined oil products, vegetable oil, easy chemicals to national and international oil companies. So we are having to get oil from one place to another that aren't typically source and destinations. For example, the countries that were dependent on the Gulf Coast, they have to find sources elsewhere. So they may be like, okay, we're in Asia, we're going to have to get our oil from the US, which exports oil, or we're going to get it from Venezuela, or we're going to get it from Norway. And we're going to have to go to a Hafnia and pay them to transport that oil so we can have it. Japan, they import like 85% of the oil they consume. So countries like that, China, importer of oil. So these guys are up 33.77. This is a good idea, by the way. Man, got two good ideas tonight so far. Accenture is a good idea. I'm going to take some notes on Hafnia. There's nothing wrong with making money. It's fun to make money on stocks. And this one here might be a really good idea. Dividends, 7.65%. Got it. And I wonder why we had this sell-off. They had their announcement on February 26th. Okay. Now that stock's trading higher. This is a small cap, tiny cap, 3.55 billion. Where are they headquartered? So they're headquartered in Singapore. Got it. All right. All right. You guys got my juices flowing. I think this might be a good one. So we got a stock that's moving higher, $3.55 billion market cap. PE ratio is really low. It's usually pretty low on these shipping stocks. They're not going to be looking like Nvidia or Apple. It just is what it is. They've really grew. Now, these guys grow by typically buying vessels and putting them into service. Now, if they were fortunate and they put some new vessels in, they're going to make money hand over fist because they're just going to be in so much demand. And they're going to ask for higher rates when they ship this crude oil. There's also probably going to be longer journeys, or what do you call it at sea? I guess we'll just go with journey. They're going to have longer journeys because it used to be, hey, I want you to move the oil from, let's call it Iraq over to Japan. Well, I can't get it from Iraq right now, so I need you to take it from Norway all the way to Japan. Oh, man, that's going to be a longer voyage. That's the word. It's going to be a longer voyage, so I got to charge you 3, 5, 10 times more. Japan will pay for it because they got to refill their reserves. So that's looking good. Big picture, Hafnia is in the right place at the right time. They're not going to have a lot of analysts, a couple. I mean, that's a pretty good number, 10 and then 9. Now, these guys got to update their forecasts because if they're paying attention, they're like, hey, you're going to make a lot of money because you have the assets to move oil, like I was just describing. And these numbers, I'm basically going to ignore. All right, so let's do a valuation on Hafnia. See what these guys are worth. We're probably going to use, let me take a look at their cash flow. So free cash flow, they went from 350, 80 to 456. I'm going to read their financials just briefly here, just to see if they can tell me if they've been buying new vessels or what's been going on with the business. All right, so there's their balance sheet. So they have vessels and scrubbers. That's pretty much consistent. So that stayed the same. Okay. I'm going to see if they have like a listing. Here we go. That's exactly what I want. Here's their fleet. So here's their fleet. So they have, this is the type of vessel they have. 106 are in service Q1 2026. A little bit more. I guess they're going to take some vessels out of service or retire them. Okay. And then rates per day. This is what we're going to focus on when they announce their earnings is the rates. If the rates go up and they can go sky high, these guys make a lot of money. They'll have these special dividends where if you recall, if you were an investor in Zim, which is another shipping company, a couple of years ago when we had the supply chain issues caused rates to go 4x. So Zim's like, cool, we got these ships. We're going to spend the same amount of money operating them. They get to charge a surcharge for fuel, by the way. So the oil they burn, they will charge the customer for the additional cost. But the rate itself is all profit, the increase in it. So these guys stand to make some good money, and it's a small cap. So these guys can start like really going higher. They're up 61%. 5-year up 100%. This thing's a money maker. And it's a good time to look at Hafnia. It's tied to the energy sector. Are they going to be put in the energy sector? Nope. They're going to be in industrials, marine shipping, but we know they're tied to the energy sector. So that looks good. All right, let's crack open that statement of cash flows. Let's see if we can do a valuation on Hafnia. All right. I don't have Hafnia there, but I have Zim, I think. So let's find Zim, and then we're going to copy Zim's valuation as an example. And then we'll complete the valuation for Hafnia. All right, so I'm just copied the valuation template that I've got. I wrote this template in Google Sheets, and it basically follows all the finance calculations that we use in stock investing. I also created an app making it easier. That's on my website, and I use it from time to time. But I like doing these by hand because we kind of go through the steps of valuing a company together. If you're a new investor or a veteran investor, this is always interesting, right? Because we really like finding companies that are unappreciated, priced really well, and are set to really go higher. And then we make money. We're always in the mood. It's like somebody who likes fishing. Who does? If you're going to take them to a lake or maybe a place in the sea where there's lots of fish, they love it. Oh man, I get to catch more fish. Well, if you have a stock investor and you bring them to a good quality stock that is unappreciated, discounted, and beginning to rally, and it has a lot of good things happening in its industry, man, we are very, very happy to be participants in stocks like that. All right. So I've been entering some data in there. Let me do a little play-by-play as I do this. So we've got trailing 12 months free cash flow is at 456 million. And we are going to take that. We're going to multiply it times 1 plus the growth rate. Okay, so the growth rate is here. Now it's not going to be a negative. Zim was kind of a weird situation there. We're actually going to take it up 25%. All right. So the intrinsic value is sky high. Now, maybe I'm being a little too optimistic there. So let's go with 10%. That way, if it overachieves 10%, it's more gravy. It's like, all right, there's only so much gravy you can have, at Thanksgiving dinner. All right, so we got intrinsic value there. What kind of cash we got on that balance sheet? The balance sheet looked okay. So, balance sheet. We've got $103 million of cash. We've got $1 billion of debt. And let me double check the share count, make sure we got the right number of shares outstanding. And it is not correct. So let me correct that. So we got a 64% discount. And let me take you through the numbers. This is a free cash forecast. Starts with the trailing 12 months free cash flow, straight out of their financials. And I'm growing that cash by 10%. So, and when we look at this first period, it's as if I'm looking forward 12 months from this moment forward. So it's going to grow by 10%. And it's going to grow another 10%, 10%, and 10%. Again, oil prices are going through the roof. There's big disruption to the sailing routes that the shipping companies were using. So there's going to be some urgency, and there's going to be some high-paying customers in this industry. It's probably going to last a couple of years, but this year and next, we'll probably see rates go up, 40, 50, 60, 100%. And that's going to be all profit cash flowing to Hafnia. So that looks good. So we're growing this cash flow, and then we're trying to get a net present value, an intrinsic value of those cash flows. And they amount to almost $11 billion. I'm going to take away the debt that's on the books, bringing it down to $10 billion. Their market cap is $3.5 billion. So it's discounted by 64%. Now, earnings per share is going to be interesting because I don't agree with the numbers that our friends over at Stock Analysis have, because those numbers were stated pre-oil prices going through the roof. So I'm actually going to say they're going to do about $1 per share. And I'm going to say, hey, these guys are probably going to have a P of 18. They're probably going to see 15% growth. So this is a good situation, folks. These guys are going to make money. It's just, the environment for Hafnia is very positive. We're not going to get out of this mess, which is this war with Iran. Oil prices going up. There's probably, governments and companies working around the clock trying to find where they're going to get oil. And they're probably going to hire Hafnia. Hey, I need you to ship this oil from this particular port to this other port here in our country, or near, if you're a company near a facility where we need it. So this is a buy all day long. It's a pretty good little situation. I'm going to add that probably as the fifth stock that's tied to energy. I was telling you what I was buying into energy stocks to kind of buy the insurance policy. Hafnia buys me a little more insurance. Woodside's flourishing. We saw that stock earlier. The oil complex is really having a good couple months. If this war with Iran continues, they're going to have a really good year, maybe a couple good years. So we will see. I'm going to put this guy in. There's a category that I put in here, and it's called buy now. That's what I labeled it. I don't have anything that's buy now, but I think I'm going to put this one in that category. I like sleeping on stocks. Sometimes I look at a stock, I think it looks great. I look at it the next day with a clear head, and doesn't look as good, or it looks just as good, and boom, pull the trigger, start buying up the stock. And maybe tomorrow we have a little bit of pullback on it. The market makes it easy for me to buy it, and I'm ready to go. So this is category 3. We are good there. This is a small cap, and this is my watch list. I've got over 380 stocks. So this is Singapore. And if you're an advanced member or a gold member, you get access to this watch list. And you can take a look at it 24/7 at your leisure. You can see my research and maybe harvest a few ideas out of it that you could analyze and then make your investing decisions. So I'm going to pop that guy there. It is categorized that, hey, you may want to buy this stock. I'm speaking to myself, of course, because it's looking really good. It's a really good idea. So I think I should give you a $5 super chat on that one, man. Atari Kid, I wish I could send you a $5 super chat because you just gave me a good idea. Thank you, sir. Please come back. Remind me of this, and I'll give you the next super chat for free, by the way. All right, Ricardo, how are you, sir? Take a look at NEE. You guys are going to keep me on energy. Everybody wants energy. It is cool to be an energy investor in 2026. These guys are up 15%. NextEra Energy, through its subs, generates, stores, transmits, distributes, and sells electric power to retail and wholesale customers in North America. So I think you've asked about this one before, Ricardo, or maybe somebody else did. And I've always thought these guys should be in a really good spot because from what I gather, they're not overly regulated, so they can sell their power to a lot of these data centers. So let's take a look and see how they've been doing. Okay. And I'm going to ask Gemini to verify that. So I'm going to ask that later. How much of their power is regulated versus not regulated? So the 1 year up 30% over the 5 year. Now, this is what I was going to say is we've had this data center build out, and this utility in particular was down underwater for a while, but I wasn't paying attention because this thing has been going up. And whoever bought it here, good job. You've made 50% appreciation on your stock, pays a 2.7% dividend. This is a big cap, 192 billion. PE ratio is a little high, 22.65. On the forward, 27.5 on the current year. Analysts think it's fairly priced. So the revenues are increasing. In the full year 2025, they increased by almost 11. And that's 11%. The demand for power isn't going away. It's increasing. Look at that, 20% growth. Now we're talking. Very good number. So the growth looks good. Now, utilities are not my favorite investments because they usually don't crank out free cash flow. Like we were looking at Accenture just cranking out that cash. Hafnia just pouring cash out of the statement of cash flows. Woodside is going to start selling barrels of oil for $100 a barrel, and they're going to be flush with cash. Well, utilities, they just don't crank out cash like other businesses. So it's not my favorite category. They're at $3,764,000,000. So they do have some positive cash flow. That's probably going to be steady and increasing because they could probably charge more for power. So we've got 13 analysts covering them. They believe it's fairly priced. And look at this growth. Looks good. Good growth. Profits are going to expand. That makes sense. PE ratio is dropping. Looks pretty good. I think I have a valuation for these guys. Let's take a look. And here's Next Era Energy. And let's see where they're going to go, because this is a little dated. It's about, 4 months old. So it could use some updating, but I think it's somewhere in the ballpark. All right, so the discount rate, I'm going to go to 8.5. As you may have noticed, interest rates are not dropping. They actually increased a little bit, and we may be there for a little while. We have inflation that's creeped up. We got this war. We got some concerns. We got some bad debt flowing through some private equity companies, as well as some of these banks. Some of these regional banks are getting stuck with some bad debt. So I'm going to go up with my discount rate. Now let's take a look at the rest of the fundamentals. I've got another screen opened up, ready to look at some data and update our valuation. Now the free cash flow, what am I doing here? So what I did here is I went adjusted free cash flow. And I think here, the reason I was doing this calculation was they were investing in their operation. And I felt like, I got to start predicting, once they stop investing so much, what's the cash flow going to look like? And that's what I was trying to do there. So let me think about this. What would be a good way? Let's think about it together. That way you kind of observe how I'm thinking through this. We're looking at the free cash flow line. Now, good data is where you have a nice smooth upward chart. Then you're like, oh, I know where the next year is going to go. It's just going to follow that trend. But this company, it's all over the place. You got some negative years in there. You got a really tall year. Man, if I was going to draw a line, I'd probably say they're probably going to hit, I don't know, 3 billion in free cash flow. So that's kind of a tough one. I guess we'll go with trailing 12 months and we'll grow it by 10%, which is going to be their growth rate. So let's get back here. We'll go with trailing 12 months. Plus growth. And the trailing 12 months cash was $3,764,000,000. And we're going to grow it by 10%. Long-term growth, 5%. Better go to 4. So the intrinsic value of those cash flows is $100 billion. All right. Let's take a look at the cash balance and the debt balance. Oof, man. Not liking the debt. So $2,810,000,000, but the debt, geez, Louise, man. Too much debt. That's a lot of debt. See these cash flows? They're probably going to be generating enough cash to pay the mortgage. I don't want them to pay no mortgage. I want them to put it on the balance sheet and then give it to me. And when you have a lot of debt, that's what happens, is you're kind of working to pay off the debt. It's almost like, somebody's personal budget. If you have too much debt, you get your paycheck and 80% of it goes to pay off credit card bills and, so forth. Not a good way. Not a good way to operate. So I'm not liking this valuation. This is upside down for me. I could buy energy stocks. I could buy Woodside. I can buy HAFN. I could buy Oxy. Those guys are going to make money in 2026, a lot of it. This is too risky for me. I have to get creative on kind of like trying to make these numbers. Remember the statement I made when I talked about Accenture, right? I started off by saying, these are not my favorite businesses, but at the end of the day, a business is its number one scorecard is making money, generating cash flow. These guys are making money, generating some cash flow, but they have too much debt. Bad fundamentals. And so these guys are absolutely do not touch. It's like a hot stove. It's hot. It's hot. And if you touch it, it's going to burn your hand. You're going to end up putting your hand in ice water, trying to make the pain go away, and then it's going to blister up. You're going to tell yourself, I knew that thing was hot. Why did I touch it? Now I've got blisters on my hand. Why didn't I listen to my intuition? And let me tell you, when I lose money, it kind of does feel like I burned my hand. It's painful. I'm not going to give them a 24. Are you kidding me? This is a utility. Now, utilities are getting a lot of fanfare. I get it. But these fundamentals are just awful. This is why I don't invest in utilities. I just took them through a valuation. We're looking at businesses, whether you're running a pizza shop or you're doing a biotech company or you're writing software or you're running a cloud infrastructure business like Nebius. At the end of the day, you look at that income statement, you look at the statement of cash flow, you could look at the balance sheet, and that's the scorecard that we compare these businesses against one another. And NextEra just does not look good at all. So hopefully you found my analysis interesting, Ricardo. You're a member. You know that I'm just sharing my comments, and I know sometimes my comments could be a little harsh on these businesses, but I owe it to you to just give you my clear opinion on some of these businesses. Thank you so much for asking about it. All right, so we've got a good number of people. We've had some good stocks come up, and we covered NextEra Energy. I wanted to cover FedEx. FedEx announced after the market closed, stocks up 9%. Now, I look at FedEx and UPS. I'm an investor in UPS, by the way. And these stocks tell us about the economy. If a lot of people are using FedEx, that means commerce is taking place. There's shipments of goods. There's transactions that are occurring. Now, this stock is doing well year to date, 23%. Over the 1 year, 44%. Hoo-hoo. Now, over the 5 year, you see where they had trouble. They had some pressure in 22, and then more recently from middle of 24 through 25, Amazon's become so big that they affected both FedEx and UPS when they said, hey, we'd like to do our own deliveries on parcel. And it really affected the volumes that were being shipped on FedEx and UPS. So they adjusted. Looks like they're adjusting well because, I mean, look at this. You could have bought the stock here and you're sitting on a really nice gain after, call it 5 months. Geez, man, you're up about 50%. What's there not to like about that? Looks good. So these guys, let's take a look and see if we've got the new numbers. Now let's look at the quarter. Their quarter grew by 8.3%. That's very good for FedEx, showing that, hey, we are getting our volumes back. You see that they hit a high back in 22, and then they had a contraction. Now they're growing again. Very good. Now, between FedEx and UPS, at least when I started putting my capital to work, I chose UPS. We'll take a look at that in a minute. Free cash flows are growing. That looks good. 4.3 billion. Gross margins, these guys are delivering parcels, so I'm not expecting them to have, big margins. Now, this compared to like Accenture, because I kind of said, hey, I don't like the low margins for Accenture. But these are two different businesses. FedEx is basically delivering parcels. They're just stamping these things out, repetitive. They have their network figured out, very efficient. It's different than Accenture that's out there trying to close the next deal and trying to deliver professional services. So that would be a distinction I would make between the two companies. Forecast for FedEx. We've got a business that's on the move, growing single digit. Now, these are stable businesses. I like them because they're lower risk than, let's say, I'm buying a nice technology grower, small cap or biotech, or some really, really interesting company like Reddit. Those are risky. Okay. Now, I want to make a good return on those. I'm going to keep buying them. But it's nice to mix in some of these old school businesses that are lower risk. All right. So enough talking. Let's take a look at UPS. We're going to go face to face off. Two opponents in the ring. Which one's going to win? We'll see. Year to date, UPS is not getting it done. I started buying it at the right time, but boy, they really have given up some of that rise. I thought it was a really good idea. It still is. I'm still up on the stock, but man, the last couple months have just been terrible. What's going on, UPS? You're on a losing streak. You should be doing better than that. When are they going to announce? April 28th. So we're about a month away from that occurring. And when is FedEx? FedEx announced today. All right. So let's open up FedEx. I think I have FedEx and UPS next to each other. So it will be easy to do the face off. There they are. FedEx, UPS. Who is going to win the match? This is like a tennis tournament. All right. So let me get this thing ready. We're going to update some numbers here. See where the valuation on the FedEx goes. So 8%, I'm good with 8%. As mentioned, I consider FedEx and UPS lower risk businesses. They've been around forever. They're going to be around forever. Very consistent. The economy needs them. So the free cash flow on the trailing 12 months is $4,371,000,000. Pretty close to where they were before. 5% growth is fine. Terminal growth at 4% gives an intrinsic value of the cash flows of 110 billion. Let's add cash and take away debt. All right, so cash is 8 billion. Debt is a little higher, 42 billion. So on cash, it's looking a little expensive. They're on a win streak, so it's looking good for them on the stock appreciating, but we're not getting there based on the cash. Do I want to crank this up a little bit? Not a whole lot, maybe 1%, because that business just grows slow and their input costs are going to change. Now, FedEx doesn't get to charge their fuel surcharges to its customers because they have kind of a negotiated rate. I think they can to some extent, but to the average person, right, you're just shipping a product or a package and they pick it up and deliver it and the pricing's set. All right, let's take a look at earnings per share. So the earnings per share. So their year ends May 31st. So we're so close to the end. I'm going to use next year's number, which is 2190. 18 is fine. Growth rate of 11%. So on earnings per share, they're discounted, not discounted on cash flow. When I blend the two, 5% discount. They've had a run up on the stock. So that's where they land. Now, our friends over at United Parcel Service, it's not a wild discount, 22%. Not a bad discount. So right now, I'm going to give the match to FedEx because they've outperformed FedEx. But I'm glad I've owned UPS, and I'll continue to own it going forward. Now, it's good to see that FedEx is doing well because it shows that the economy is doing well. And so is UPS. UPS is up 1.5%. They can thank FedEx because they had a very good earnings. So investors are like, hey, well, FedEx is doing well. UPS is probably doing well too. So that's what's probably happening there. All right. So that was FedEx combo with UPS. I updated the valuation, and keep in mind that valuation on FedEx updated to the watch list. So when advanced members take a look at the watch list, or gold members look at their watch list, that has been updated for them. All right, guys. So it's going to be short and sweet tonight. I appreciate you guys tuning in to the PM stream. I'm going to try to do this every week. I was really busy and wasn't able to do it, but I feel like some of the members of the channel, you guys are on the West Coast, or maybe you work and you can't get to the streams in the morning. So I wanted to have these, and it looks like Kurt is on. And it's I appreciate the feedback there, Kurt. I'm going to try to have these streams in the evening. A lot of good stuff happens in the evening streams, and I want to keep them going. So this week, I streamed on Tuesday and on Thursday in the PM hours. And I plan to do that next week. Join me if you can. Until then, you guys have a terrific evening. Good luck with your investments. Let's see how we can outperform this market, because it has been a tricky one here in 2026. But, when stocks sell off, opportunity is knocking on our door. If we do our homework and pick the right companies, we can make a lot of money year after year. So let's focus on that task. And I wish you the best of luck with your investments. Thank you for tuning in. Have a good night.